Hey everybody, Tom Gentile. Happy New Year to everyone. This is our very first Optionetics webinar of 2019. Glad to see so many people coming in to hopefully make your 2019 the best year you can as a trader. That's what we're here to do, is help you do that. This gentleman that's with me is one of the best. I get more people that want to listen to the particular type of way that he trades than literally anyone else. And so I'm glad, we only do this once a year. I'm glad that he's back. We're going to be talking earnings. We're going to be talking how to trade into the earnings season. We're going to talk about delta neutral trades. But before we do that, let's talk about the disclaimer for a moment, and let's talk about how we're setting up the room. So first of all, session is being recorded. All right, I'm going to send it out to you guys as soon as I can after the live event is over. Number two, if you've got questions, you can put them in the Q&A box. We will answer as many of them as we possibly can. And the ones that are the more popular ones, we're going to be reading out and answering right here live in class. And then the third thing I want to mention has to do with this disclaimer. All right, you can read this in its entirety on the recording when we send it to you. All you got to do is pause the recording. Couple of points I want to make out before we begin. Number one, stock and options trading has large potential rewards, but also large potential risk. And number two, myself, Jay, Mike, everyone associated with Tom's Trading Room and Optionetics, we're here as your educators. We're here to show you how it is we trade. We are not investment advisors. We do not give personal investment advice. Everything we're going to talk about tonight is in US dollars unless noted otherwise. Other than that, thanks for being here, guys. And the first thing I want to start off with, well, first, let's welcome Mike Wade. Mike.
Hey, good morning. How you doing?
You're not in the U.S. tonight. You are, by the way, everyone, Mike, what time is it where you're at?
3 a.m.-ish, something like that, just after 3 a.m.
And exactly where are you?
I'm in South Africa.
You are a good man.
I came down here. Yeah, I came down here to, trading affords us a lot of freedom. So I came down. I've been down here for about 3 weeks now. I just came down and did some philanthropic work, and have been doing safaris and just enjoying Africa. I've always wanted to be here, and but I love doing this too, Tom. So I'm very happy to get up early in the morning to be with our students, particularly the Optionetics ones, which I have a long history with. So this is a joy.
It's awesome, and I think New Year's, just after New Year's is a great time for people coming out of holiday. I mean, I was on holiday for, gosh, I want to say, it was almost 2 months with family. We couldn't get rid of them. And so, if you're like me, guys, any of you are like me, you got to, you got to start your New Year's resolutions a little bit late. Anyway, yes, I got a poll on this. I got a quick poll for everyone to start off here, and the quick poll says this: how would you classify your trading activity right around earnings? And select one of the three. So I've never traded around earnings because I've heard it's too risky. I trade earnings off and on, but I don't have any set rules. I trade like Mike, and I love his approach to earnings. So I'll give you a couple more seconds to dial in there. Get your vote in. We're not going to see your name. This is all anonymous voting. All right. It's one of three. You can't pick more than one. So pick the one that best fits you. And so let's go ahead and we'll close that poll up. I'll give you 5 seconds. I know I got more people coming in the room, and they're coming in the room and they're seeing this thing. What do I do? But yeah, with a quick poll, read the question, pick an answer, click on the submit button, and we'll see how you did. All right, so let's close that up. And Mike, we should have a results here. Let me show you the results. So what do you think, Mike? Is this something you work with? So 40% say I've never traded around earnings because it's too risky. 53% say I trade earnings off and on, but I don't have a set of rules. And 7% obviously know you, Mike, and they've traded with you before. So again, not everybody does what you do, Mike. Not everybody trades like you. So it's it's interesting that you have a uh, an approach, but also it's one that's kind of highly guarded, isn't it?
It is highly guarded. It's a very sophisticated and unusual approach to trading earnings. And when I was a trader, Tom, early days, I was a naked put trader. I got into credit spreads and I avoided earnings. I just didn't want to play with them. I didn't think straddles worked. I thought, maybe I'll get a 1 out of 3 chance of winning, and so I stayed away from them. So I'm not surprised by the results. The fact that 7% of the people have traded like me means they've been in the class. But I'm quite certain that after you see what we've created with Tom's tools and his developers, that you'll be one of the 7%. It's very compelling, and this is coming from a credit trader. I still do credit spreads. I love them. They're exciting. They're fun. They're high risk. They're high reward. It's very exhilarating, but at the end of the day, trading is about keeping your risk low and making money without a lot of stress, and that's became really important to me. I guess when I reached 50, yeah, I'm in my 50s now, and when I reached 50, I was like, I don't think I want all this stress. So we've been developing this system with Tom's developers for quite a while now, like 7, 10 years, something like that. And it's very sophisticated. It's very elegant. I would say in a nutshell, it's a strategy that allows you to sleep at night. One of our students calls it the Beautyrest Strategy. You're just not going to get hurt too badly with this strategy, and it works historically. So I'm going to give you a lot of stats and show you some examples of how all this works.
The best
So
thing,
our
the best thing too, Mike, and I might mention this, is it's actually easy to understand. It is rules based, and so get on into it, Mike.
Yeah, man, and it is easy to understand. I'm going to amplify that point, Tom, and I know that we have a lot of optionetics students on the call, and welcome to the call. It's good to be with you, although I don't know exactly who's here. I know that I probably met most of you over my tenure as an optionetics instructor since 2002. And what's typical is that we find in the trading community is that um, some traders, a lot of traders actually sort of like they get into it and then they fade away and they stop trading. And this may be the strategy for you because it is extraordinarily simple. Straddles, you're buying a call and a put. The system's going to tell you when to get in and when to get out. You just literally you buy a straddle on one day and you sell it on the next. And if you do it the way that I do it and through the scanners, then you'll have some really nice results, provided history repeats, which it tends to do, of course. So this may be the strategy for you. If you're one of those that are sitting on the sidelines and spent money on education and then trading sort of fell away or didn't become part of your daily revenue generating activities, this I would say this is the strategy to really take a close look at. So for tonight, what we're going to do is take a look at the market. Let's do a quick market outlook. And then I want to talk to you about how we find earnings patterns with 100% historical accuracy, regardless of market direction. So since October, the markets have been extraordinarily volatile, right? So if you're a directional trader, that's great if you're right on direction, but it can hurt you quickly if the market moves the opposite way, which has done a lot of since October. And I'm going to show you how to find low-cost opportunities for typically less than $500 a trade. So these straddles that we'll be talking about tonight are not like they aren't going to cost you $10,000, $15,000 a straddle. They're going to be typically less than 500 bucks a straddle, and they don't take long to come to fruition. We're going to get in and we're going to get out and take our profits within roughly 10 days or less, sometimes more, sometimes less. So that's our focus. We're in the heart of earnings season. There's a boatload of opportunities coming up in the next couple of months into February and also into March. I'm going to share with you a case study that is, I think, one of the best ones of the quarter. So you'll have that to play with. Its entry, I believe, is on the 29th, which is coming up here shortly. And then I'm going to talk about how you might trade straddles in the way that I trade them. All right, so let's get started with taking a quick look at the market. So let me pop into the stock chart tool within Tom's tools, and you can see what's happened in the market. This is the SPY, the ETF that tracks the S&P 500, and you can see back here in early October, the markets did what they did. We all know they tanked and rebounded, and then tanked again and rebounded and tanked a lot, and then since then we've been in an uptrend. Now, if you're trading directionally in this market, imagine you're bearish here and the market drops and you're right on your particular stock. Maybe you're trading the SPY, in fact, and then the SPY bounces back up and then you end up with a losing trade. So this volatility, you just don't know when there's going to be a bounce. This volatility for a directional trader is really good when you're right, but at any point in time, a rebound can really sting. So volatility is really great, except when it's not. And so it creates a lot of stress and anxiety for a lot of people. But here's what's happening now. This is what I would say. I would say, look, the markets have tanked. We've dropped all the way to 2,350 on the SPX. And then we've had this bit of a run up here. And Tom, you may want to jump in here with your own opinions, but one of the things I look at is volume. Just really simply, you can see on this chart that the red volume eclipses the up volume, which is green. So red volume is down, green is up. And what I notice here is that on the you'll notice here on the drops in the market, this one here in particular, this one, you can see that the implied the volume itself, the conviction, the institutional conviction rises, and then as the market has rebounded, notice what's happening to the conviction. I like to think of volume as conviction. So this uptrend here seems to be not as convicted by institutional standards anyway. So I'm looking at this thing going, well, I don't know if that's going to hold. And then I look at an indicator like ADX, a average directional index, and this blue line indicates that the trend strength is weakening. So I'm not sure this is going to hold. I think based on just those two indicators, volume and ADX, that we may be looking at another dip in the market. So whether that's true or not, I would say that volatility, it looks to be likely to increase or to stay, and that for me, for a straddle trader, is a good thing. So I'll tell you one thing. In October, when this happened here, I publish trades each month, and since August, we've done really well. In October, when this happened here, we were in a bunch of straddles, and of course, any volatility for a straddle trader is a really, really good thing. So, sum it up, Mike. Volatility is likely to continue, and if you're trading straddles, that is a really, really good thing. Tom, any more from you? Do you have any opinions on market direction or volatility coming up in the next few months here?
We do, with our group, our members, we do a live market stuff, 4 days a week, and every week I do some information on where I see the markets going, and I look at the four corners of the market. And basically, we're in a really interesting area right now because we've made about a 50% retracement. 38 to 50% retracement off the highs that happened back in September on the S&P. So it's going to be interesting to see whether we plow through that or if this is just about a calling for the bears to come back in. But what you're going to show everybody really doesn't matter.
It doesn't matter. Exactly. That's the point. That is one of the benefits of straddle traders is we don't care. I mean, if we would prefer the market to move, but what we've done in this system, Tom, is we don't even need the market to do anything. It's not contingent on directional movement. It's contingent on something else, and I'll reveal that as we go along. So let's just say, let's just set the table a bit. Let's just talk about if you happen to be bullish on Kroger. This is a dated chart, but just for the sake of a discussion, if you were bullish on Kroger, you would buy a call option. This is a risk graph of a call option. And what are the risks of a call option? Well, one of them is time decay. Kroger is going to do one of three things, right? It's either going to go up, It's going to go down or it's going to continue sideways. The only way a call option makes money is if the stock actually rises. So if Kroger kind of stalls out, then what's going to happen to your call option? Over time, these risk graph lines indicate these are just like three cross sections in time. Over time, what happens is time ticks away, tick tock, tick tock. Time works against you. So that's one of the drawbacks of options, is that time works against you if you're buying them, of course. And the other is if the stock doesn't move, or even worse, if the stock drops, then you're looking at a losing proposition. All right, so is there a way for us to mitigate directional movement? So could we make money to the downside as well? Well, yeah, you can with a straddle. So a straddle is about buying an at-the-money call and a put at the same strike and the same expiration date. You all know that. And these straddles, because you're buying a call and a put, that essentially increases your directional probability. So now you have a trade that makes money if the stock goes up or if it goes down. All right, so these straddles are limited risk, and then there's a greater reward to expiration because you're actually playing both sides of the fence. So let's look at Kroger once again as a straddle, and here you can see that, yeah, we have a straddle in which if the stock goes up, we make money, and if the stock goes down, we make money. A lot of new novice and even novice option traders think that's a great deal, right? Stock moves up, I make money. Stock drops, I make money. That's a great proposition. However, the risk here is now that you have two options that have time decay risk. So essentially, when you put on these straddles, time decay is your enemy. Theta, if you want to get Greek about it, theta is your enemy. So every day you lose double the amount of time value. So that's one of the reasons. That's really, I would say, one of the ultimate risks of a straddle. But there's others, right? So what are the biggest risks to straddle traders? One of them is if the stock doesn't move. So yes, we have a benefit in a volatile market in particular. If the stock moves up or it moves down, that's a good deal. That works for us. But if the stock doesn't do anything, and there's a lack of direction, then we will definitely lose money. Theta risk, that's theta kicks in, stock doesn't move, theta starts eating away at your position value on a day-by-day basis, and that number, that amount of daily risk increases as you approach the earnings announcement. And then, of course, there's vega risk or volatility risk. It's also possible that the volatility move against you. So these are some of the reasons that, when I first started trading, as I said, I was a naked put trader before I met Tom, and then I became a credit spread trader. And I avoided straddles. I was like, man, I don't know, I don't want to deal with all these risks. And then I saw something about 10 years ago that I'll share with you in just a moment that
Hey,
really
Mike,
got me thinking. Yeah, buddy.
let me grab the screen from you, because I'm going to
Oh,
show everybody what I think the way most people actually think about approaching and trading a straddle.
yeah.
So let me flip the screen.
Uh-huh.
So I'm on the screen right now. At least I think I'm on the screen. Okay, here we go. I'm on the screen. Should be on the screen now. So I brought
Yeah,
up
I
an
see it.
option chain of Amazon, okay? Because this is the way a normal straddle trader or someone who's new to this, they say, oh, I'll buy a call and I'll put it at the same time. And that's great because now I can make money regardless of market direction. And yeah, there's a chance that can happen. But in a normal straddle, your chances are much, much less than 50-50 that you're going to break even. All right. Anybody who's ever traded a straddle before knows that your probabilities on an average basis on a stock are less than 50%. Right? Yes, it has unlimited upside and it has a lot of money you can make to the downside, but the probabilities aren't there. But there are certain times of the year where the probabilities actually swing into your favor. Now, that's the first thing. But here's the other thing. I hear a lot of new traders going, well, why don't I just put a straddle on Amazon? I mean, Amazon's all over the place every day. Well, I'm going to show you why. So here's a straddle 30 days into the future. All right, you got to go down a little bit to get there. So it'd be the 1655 calls and puts. If you bought the 1655 call, by the way, $76.53, and the 1655 put, 74.20. This is 30 days out. You're looking at a straddle that's going to cost you $15,000 for one straddle. All right. Now I can tell you right now that the majority of straddles that Mike is talking about cost an average of about $500 a piece, and they're on the right side of probability. And it's a tough to see that because probability just looks at numbers only. It doesn't look at events or upcoming events. And so, you can do it the way everybody else does it, where you're risking a lot of money, or you could look at really just the timing of straddles to specific events and playing them around that event. And so that's what I wanted to show everyone real quick, is just that's one of the biggest things that draws people away from straddles. And so, Mike, I'm going to turn it back over to you so you can show them exactly how this is done and why this event-driven straddle makes a lot more sense all the way around.
Yeah, man. Sounds good. Thanks for sharing that.
You are welcome, and you are now back as the presenter.
All right, I got it. I have the con, as they would say, on a submarine. All right. That reminds me of Red October. I was just watching that movie a couple weeks ago. I've seen it 10 times, and now that I'm in my actually I'm approaching late 50s. I forget movies now, so it's like I watched it for the first time again about a month ago, and yeah, so I have the con. All right, so let's get into Straddle Mastery. So great traders, and I guess I'd have to consider myself to be one of those. We actually dig in and we look for patterns, and we try to find things that others don't look at. I learned that from Tom. Tom is a master at that, and I have everything I just really want to acknowledge that my trading has been greatly impacted by Tom's approach, and this is an example of that kind of thinking. So we're going to talk about this new way of trading straddles. So there's a particular pattern that happens with some stocks that happen to gap over earnings, and this pattern caught my attention about well, it's always had my attention since I've been trading, but I really got into this mindset about how can I take this pattern and make money with it. And it happens to be the implied volatility pattern for stocks that gap at earnings. So we're going to get into quite a bit of detail on that, but that's really what it comes down to. And so about 10 years ago or so, I started getting into this particular system, and I approached Tom's developers. They're literally rocket scientists. They're brilliant guys, and I approached them and I said, I want you to help me figure this problem out. And again, I'll disclose that in a minute. And I got to tell you, I haven't met anybody. I'm in the trading community. I haven't met anybody that trades straddles like this. It's sophisticated, it's elegant, it's smart, it's behind the curtain, it's dealing with human psychology at gaps, and it is just a gorgeous strategy that very few people know about. So if you're on this call tonight, then you're one of the few that know about this particular strategy. So really what it's about is finding stocks that gap at earnings. So each earnings season, and believe me, there's earnings every single month. There's a concentration of earnings, January, February, and then every 3 months after that, there's a sort of like a sweet spot, but every month there's earnings that we can go out and find these opportunities. And a way to think about it, Super Bowl is approaching. There's two teams in the Super Bowl that one of which I'm not particularly fond of, but think of the Super Bowl. So if you wanted to get Super Bowl tickets, you could go to the event 30 minutes before kickoff, and you could buy the tickets. And then as soon as the event starts, the kickoff starts, the price of that ticket that you might have spent 3, 4, 5 times face value for actually collapses. So what causes that to happen? Why would people be willing to spend $15,000 for a Super Bowl ticket when the face value might be $2,000? Why is that? Well, the event is so amazing. The expectation of the pleasure of the event is so amazing that people would be willing to pay more, and the price would rise as the kickoff time approaches. That's similar to an earnings announcement in the stock world. So for stocks that gap at earnings, what happens is option traders come in and they say, hey, tomorrow Amazon's about to announce earnings, and the last 15 earnings periods it gapped, so let me buy some tickets to this event and let me see what happens. And the outcome for them, the anticipated outcome, of course, is that they're going to make money on a gap. So it's the same kind of thing. We're scalping tickets. That's what the strategy is all about. So let's get into the meat of the presentation. Earnings announcements are frustrating for most and profitable for the few. It is our hope that you will be one of the few that know how to actually trade earnings. All right, so let's talk about earnings announcements. So here's apropos, Tom, here's Amazon. And you can see here, Amazon, this isn't a dated chart, but it still does it. On this chart, you can see 4 earnings periods, and Amazon gap down here, up here, up here, up here. It's very, very difficult to predict future prices from earnings announcements, and they might be great earnings announcements, so there might be disappointments, and the stock could go the opposite way you would expect. So if you're a directional trader, we always teach this at Optionetics, stay away, get out, because you just don't know. You just don't know which way it's going to go. And good news doesn't always lead to higher stock market prices. Here's an example of Green Mountain Coffee announcing good earnings, and each time it gapped down. Same thing happened to SanDisk. SanDisk had 4 positive earnings announcements, and each time the stock not only went down, but it gapped down. So these gaps create demand, and the demand is captured by what we call implied volatility. So implied volatility boils down to one thing, and this is it. It's demand. So if the demand for the options increases, market makers will lift the prices up. You do the same thing, I would do it. So implied volatility is really this is where the sophistication comes in. Most option traders, I can't say most, many option traders don't even consider implied volatility. All right, we're going to consider it. In fact, we're going to understand it, and we're going to flip the table, and we're going to make money on it. And this is an example of an implied volatility chart on one of those stocks I just mentioned, Green Mountain Coffee. All right, so this is dated, but the fact still remains. You can find these patterns all over the place. There's several stocks that have these kind of patterns. The trick, of course, is to find them, which I'll show you how to do here in just a minute. But really, what you see is a bunch of colored lines. So we have a short-term implied volatility line, which is red. We have longer term, which is blue. We have even longer term, which is green. And we have the longest term, average of 90 days or beyond, which is black. And notice what happens in the shortest term IV. So you see these red lines. All right, and you'll notice as well these earnings announcements. All right, so here's the kickoff time for the Super Bowl, and the scalp ticket prices rise and rise and rise and rise right into the kickoff, and maybe a bit later, but let's just say right into the actual kickoff time. And then as soon as the ball is kicked, then those tickets become far less valuable. And the same applies to earnings. The earnings announcement, it's almost 4 o'clock. Option traders come in, they say, oh, I want to get in, I want to get in, I want to position myself for a profit on a gap, and they'll pay a premium. They'll pay a premium to participate in the event. And that's the pattern. This pattern is reliable and repeatable. Notice each earnings announcement, spike up in IV, crash, spike up in IV into earnings, crash, spike up into IV, crash. It goes on and on and on. So trading for me, and I think for everybody, is about finding patterns that are reliable. And I can build a system around the patterns that actually makes money, and that they repeat. They tend to repeat. History will repeat itself. It tends to anyway. And that's the idea. So the question is, and this was my question about 10 years ago when I approached Tom's developers. I said, how do we make money on this? All right, I know that the stock's going to gap at earnings. Maybe it won't, but that's the likelihood. How can I profit on these red waves? And that's what we want to talk about tonight. And there's a way, of course. It's the way that we're doing straddles. This pattern is all over the place. Here's an IV chart on Amazon. Same thing, right into earnings. IV spikes and then collapses. IV spikes and collapse over and over and over again. All right, so this pattern is pretty much invisible to most option traders. They don't even consider it. In fact, I've not seen this pattern, this IV chart in many places at all. And Tom's Tools, of course, gives us a really good, vivid look at the impact of demand on the price of options. So what we're doing here with these types of straddles is trading demand. We're trading human psychology. SanDisk, same thing. So these patterns are everywhere. All right. So how do we make money on these things? Well, first off, we want to mitigate directional risk. So I don't want to buy a call option because the stock may drop. I don't want to buy a put option because the stock may rise. So what we do is we buy a straddle. And we need to buy a straddle somewhere on this red wave. So where do we buy it? How many days before the earnings announcement do we get in? Now, why do I care about that, you might ask? Well, because we're using short-term options in this strategy, it's important for us to stay in as little amount of time as possible. Because remember, theta, or the impact of time decay, gets more negative as we approach the expiration date of the options. So the mathematical problem is, what's the optimal day to get in to capture the IV rush and offset it, and have that offset the impact of time decay? So try to solve that manually. It'll take you years to do it. So what we've done with these scanners that I'll reveal to you in just a minute is that we can actually detect in a brute force manner what is the optimal day to get in. Maybe that's 10 days before earnings. Maybe it's 5 or 1 or 12 or 22 days before earnings. But the software actually detects it. So we pick a point based on what the software tells us, the scanner tells us. We get in at a certain point, and then we get out right before the announcement. And that's really key. So before the event, we're out. And that's the sexiness of this strategy. We get in and we get out, we take our money, we reduce our risk, we mitigate our risk to a large degree. We can sleep at night. We're just not going to wake up in the morning with a 50% loss. It's just not going to happen. Take it out of your consciousness. It's not part of the strategy. You might lose a little bit, and that's the deal. So when do we get in? When do we get out? And the software actually tells us. Again, the exit date is always right before the earnings announcement. So it's very smart. It's a very smart strategy, and it's very, very easy. I'd have to say, Tom, this is the easiest strategy I've ever done. And it became easy because of the work of our rocket scientist developers. I'm going to come back to this in a minute, but I want to show you a couple of these things. Shake Shack. You know, I've been trading a long time. I quit my job in '98, May 28th, 1998, and it's always been fun for me to find a way to make money on a company that I spend money at. I'm a big Chipotle customer, and Shake Shack is on my list. I haven't eaten at Shake Shack yet, and Tom tells me there's a Shake Shack in the Atlanta Concourse A. I'll be there on Monday, so I'm going to stop by and grab some of their food. But it's always a good thing. It's always fun to actually make money using trading the stock of companies that you spend your money with. So here's an example. This is what I call a red wave. So this is surfing that red wave, getting in, getting out, short-term options. Software tells me it makes a lot of sense historically, 100% accuracy even. And we got into this particular straddle on the 16th of October of last year. And this was the straddle. And you can see it's perfectly centered. The stock is volatile, which is always good. Earnings is coming up in 16 days. So we got into this trade 16 days before the earnings announcement. And the implied volatility was kind of down here. All right. So what we're anticipating is that the implied volatility will rush like it's done the prior earnings periods. That's one way we'll make money. The second is if the stock actually happens to move. 16 days now. Let's go to the exit date, which was on November the 1st, 16 days later, and we're sitting at $1,000 profit on $753 of risk. We actually delta neutralized this one, which we can talk a bit about later, but we ended up with 142%. And why did that happen? Well, the stock actually gapped down a bit and then rose, but notice my theta lines are completely into profit. Worst case on this straddle, I would have made $933. Now imagine that. You're in a trade where worst case is that you make 933 bucks. You go to sleep and you're thinking, if I wake up tomorrow, the worst thing that's going to happen to me is that I'll make $933. This sleep at night strategy, the Beautyrest strategy. Look at what happened to the implied volatility. It just skyrocketed. We rode this wave. The implied volatility came in to such an extent that it really helped us push these profit lines deep into profit. And there's plenty of these examples. Here's another one on Curtis Wright, CW. We got in on the 17th. Here's the risk graph. You can see here the stock's very volatile. That's always icing on the cake. The implied volatility was right about down here. And then this was a 13-day trade using 30-day options. We got out on the right before Halloween for a 39% profit. So this was a, let's see, 13-day trade. We made 39% profit with virtually no risk during the life of the trade. That is that's the secret sauce to this thing. You know, the whole idea of getting blown away overnight or really taking a hit, it just gets taken out of play with this strategy. It does really reduce stress levels and increase your comfort and fun. And the strategy is not just confined to these red waves, getting in and getting out before earnings. We also still use the software to go out and find really great breakout opportunities. So, you know, stocks do break out, and sometimes they make money, sometimes they don't. But the scanners tell us that on these particular stocks over history, 100% of the time they made money. And in fact, they made an average of X percent. So we can have history as a guide to tell us that in this case on AT&T, I can tell you, knowing AT&T and what the stock typically does, I wouldn't have even thought about AT&T as a straddle. Certainly not a breakout straddle. But this is what happened. We got into a breakout straddle, which means hold the straddle till after earnings. We got into, you know, following the rules, 60 to 90-day options at the money straddle. There's our straddle, beautiful centered straddle. The volatility is right down here. And then the day before earnings, we haven't even had the earnings announcement yet. We were up 43% on this straddle. Look here, you can see the stock price moved up a bit, but not much. But what happened? Look at these colored lines. They got pushed into profit. How did they get pushed into profit? Time decays moving them this way. So something must have driven these lines into profit. What was it? Well, it was implied volatility. You can see the IV rushed up and it pumped these lines into profit. All right, let's go one more day. So we had 43% the day before earnings. Then after earnings, the icing on the cake on this trade was that the stock actually gapped big, producing a 57% profit in a handful of weeks on AT&T of all companies. Let me give you a quick track record. These are just a handful of the trades that I've published since August of last year, and you can see we had some really big winners. I mentioned the Shake Shack. We had a small loser on Pfizer. CW I just showed you. We also had a 26% return on FIS. DXC was a 10% loss, and then AT&T, I mentioned that one as well, was a 43% profit. And those are nice numbers. These profits are nice numbers. All right. Now they're not doubles. Now, so what about that? Let's think about that. They're not doubles, but they're substantial. 57% in 16 days while you're sleeping at night, while you're greatly, and I would say as much as possible, mitigating the risk. It's huge. All right, and you can see it. It shows up and it shows up and it shows up. So think of this strategy as a sleep at night strategy. You buy a call and you buy a put. You buy a straddle, and then on the time of exit, a certain number of days later, you simply sell what you bought. That's the system. That's the mechanics of the system. That's what it takes. You need the scanner to tell you how to find these strategies. But really, and I'll leave you with this point, the most powerful outcome of this strategy is what you see in red here. Losses are mitigated to a very, very large degree. I would say the losses are somewhere, average losses are somewhere in the 15% range, maybe 20%. So they're small. Average profits are in the 30% range, somewhere in there. So you're just not going to get hurt. And that to me is the best thing. You know, I met Tom and George back in I met George, actually I met George in 2001, and then I met Tom in 2002. And George said something in a seminar once that I hadn't heard before. I took other trading education before I met George. And George said, the number one rule in trading is to ask yourself the question, what if I'm wrong? And the job of a trader is actually to mitigate risk. And so this strategy, because it's a straddle, and because we're being elegant about implied volatility, does that. You're just not going to get hurt. And that's the bottom line. All right, so this is the performance of the published trades I've had so far this year, and we've made money. 58% of them have been winners. So history doesn't always repeat itself. Somewhere in the neighborhood of 60% of the time it does, at least with the trades that I've published over the last 3 years. This is the last since August, so let's say 9 months. The average win to loss is somewhere in the neighborhood of 2 to 1 or just under, or sometimes over. So let's say roughly 2 to 1. And, you know, here's the thing about trading performance. You're just not going to win all the time, and that's always going to be the case. So a system that works is offering you historically 60% accuracy. So 60% or so, somewhere in that neighborhood of your trades are working, and your average gain should be somewhere in the neighborhood of 2 to 1. This system has done this. This is the last 9 months. The prior year and the prior year before that. These are the numbers that keep consistently playing out with this system. And these numbers work, the math works. You will make money in your portfolio with this kind of performance. All right, so that's what we do. And for 2019, just to summarize, we have a scanner called the breakouts. These are part of the Straddle Trapper scanners. We have a breakout straddle, we have an optimal straddle scanner, and these scanners are extraordinarily powerful. On a brute force basis, it takes all the stocks that you give it, and it goes out over the past 4 to 10 earnings periods and detects what the optimal entry date is to maximize your return on investment. It will also reveal to you which patterns have 100% historical accuracy. It does all that for you. Now, I'll just say a quick side note. When I first started doing this, I would do this manually, and it would take me hours for just a handful of stocks. In a matter of seconds, you press a couple of buttons, and it comes up with stocks that work with 100% historical accuracy. So that's what's happening in 2019. I'll tell you that because of the market volatility, this particular quarter in Q1 is really target rich. There's a lot of really great opportunities coming up, and I wanted to just really be generous with you and share with you a really, really good one. And this is on Phillips 66. This is a straddle. The symbol is PSX. And you might want to, your eyes probably went directly over to this number here, which is on average, PSX has generated a 78.64% return over the last 4 earnings periods, and with 100% winners. 4 wins, no losses. All right. So that's very enticing. And the scanner comes back and tells you, all right, you need to get in 10 days before the earnings announcement. Not 9, not 11, not 15, 10. Why 10? Well, 10 maximizes your return on investment and will provide you 100% wins. There's other data here that I'll tell you about if you decide to go forward with us. But really, this is what it comes down to. You buy a straddle on January the 29th, and you sell it on the 27th before market close. That's it. You buy a call and a put on January 29th, and you sell that straddle on February the 7th. And you sit and you wait 10 days. And if history repeats itself, expect somewhere in the neighborhood of 8% a day of profit. That's what history tells us. And that's our only guide as a trader. So that's the power. Here's an example of the straddle had you placed it today. The strike prices will likely be different on the actual entry date. So be sure to follow these rules here. So the action to take on Tuesday, January 29th of this year is to buy to open a PSX February 08. These are the options for February that expire on the 8th of February. And buy an at the money straddle. So whatever the closest strike price is to the stock price, those are the strikes that you want. Buy that straddle in the last hour of the day. And then the exit is the day before earnings on February the 7th on PSX. Sell the same straddle during the last hour of the trading day, and then you're out before the earnings announcement. We do not want to deal with any IV crush. We get in, we get out before the event. That's the sexiness of this particular strategy. Now, let me ask you this question. Look at this. February the 7th is the exit, and the options expire the next day. Yes, ladies and gentlemen, we are trading into the last day of time on these options. Why would I do that? Well, the software tells me historically that works very, very well. All right, here's some of the other ones we're looking at for this year in the next quarter. All of these are entering after January the 30th, and you can see some pretty big names in here, including AIG and Prudential. And look at these returns on investment. They're pretty gorgeous. 110% on AIG, 64%, 49, 44, and almost 40 again on the last one. So that's the kind of stuff we're looking at going forward over the next couple of months. And those of you that decide to join us will have access to these, of course. And really exciting. There's a lot of good stuff coming up in the next couple of months here. So I got a question for you. So with an eye on performance, we're systems traders. We're looking for a system that produces somewhere in the neighborhood of 60% wins, with the average win being twice the size of the average loss. If we have that, then that system mathematically makes money. All right, so with that context, let me ask you this question. If I was to show you a system that in one quarter of 2018 generated $33,000 of profit, with 72% of them winners, and the average gain just under 4 times the size of the average loss, would you be interested in learning more about this system? You might be. Let me ask you another question. If I was to tell you in another quarter of 2018 that this system generated $50,000 of profit, 96% of the trades were wins, and the average gain 3.5 times or so, the size of the average loss, would you be interested in learning more? And let me sweeten it a bit. Would you be interested in this kind of a system that can generate these kinds of results while being able to sleep at night because it's based on straddles? You're just not going to get hurt using this system. Would that be interesting to you? Jay, do we have any responses at all to that fairly rhetorical question?
For someone, it's not only rhetorical, it's pretty obvious, but the answers
exactly.
are coming in yes. Yeah,
Well,
it's almost
I anticipated
not
that.
almost. It is unanimous. It's yay, yes.
It's unanimous.
Yep.
Yeah, so this
Yes
is
in
the
all
new
its form
thing.
coming through, Mike.
Right on, man. I knew the answer already. I didn't have to even ask you. Yeah, so this is the next version of Straddle Mastery. So far what we've done is we're trading into the earnings announcement. And then there's a period of 3 months for every stock where there is no earnings announcement. So what this strategy allows us to do is to actually trade after the earnings announcement and approach the upcoming earnings announcement. So it gives us wall-to-wall straddles throughout the year. Again, all of these straddles are based on historical performance. And the system that we're talking about is called gamma scalping. It's a technical definition. You can read this if you like. It's about really adjusting delta neutralizing straddles to essentially, and really at the end of the day, to scalp enough money to offset the time decay of the position. So basically reducing risk by delta neutralizing. That sounds very technical and complicated. It isn't once you understand it. But I just want to reach out and acknowledge one of your partners. His name is Dick. And Dick has been a partner for 2 years now. And I think even before that, I met Dick 2 years ago. And he told me, I've been taking all these classes, but I just haven't done the work. And he promised me 2 years ago that he was going to dig in. He loved the straddles, and he's been doing a copious amount of back testing and has produced these results. And these results have resulted in getting our attention. And we are actually, as you'll see in a minute, going to take these results and build a button around them. So just briefly before I talk about that, let's talk about what it is. So the gamma scalping with these amazing results that have been achieved by Dick are essentially giving us the ability to actually continue the strategy between earnings announcements. So as good as red waves and some of these breakouts are, it's been performing exceptionally well. This is really icing on the cake. It just gives us that much more opportunity to generate consistent profits. So these are called gamma straddles. The gamma straddle button has been under development for almost 2 months now. We're meeting next week to take a look at the button and see what's working, what's not. We're going to refine it. We're going to incorporate Dick's rules. We're incorporating our own rules, and our intention with the button is to produce those results. So think of it, this button will do a brute force historical scan to find only the best performing stocks. So that's the key. Historically, does it make sense to do these gamma straddles on, let's say, a stock like Amazon? But the scanner will tell us exactly which stocks it works with, produces the results that allow us to do our analysis. The second part that the button will do is once you have a portfolio of trades in motion, the scanner will actually tell you on a day-by-day basis when it's time to actually adjust or to delta neutralize. All right, so that's the button, and it's preliminarily it's looking really good, and we want to bring this into the Straddle Mastery fold. Tom will tell you more about that in just a minute. All right, so that's a top level view, Tom, of what I've been up to, and I wanted to just open the floor just for a few minutes to see if there's any questions, and we can answer them together.
All right, Jay, anything you see on the Q&A board?
I'll keep it short. The primary one coming in, and you've talked about it, Mike, already, but if you could just reiterate your average position size per trade.
Yeah, very good. So in my publication, I position size to 2,000, but generally the cost of one of these straddles is less than $500. That's what it comes down to. remember, we're using short-term options. We're using options that might even expire the day after exit. And because of that, the cost is very limited.
And I'm also going to add to that before you ask any more questions too, Jay, is, think about this, guys. Straddle earnings season is feast or famine. And what that means is that there is a good month where we run into the sweet spot. All right. We're running into we're coming into the beginning of that sweet spot right now. So that it typically happens around the third week of January to about the third week of February. All right, and then it'll cycle again in 3 months. But between those weeks, there are companies that put earnings out. They're not rushing to put earnings out like they are, following either a calendar or a fiscal quarter. And so think about this: is that of the thousands of stocks out there, and every public stock that trades has to issue sales projections, earnings, pretty much anything that's transparent that can move the stock price. They have to offer that up. And so, of that, do we find patterns on every single one of them? No, we don't. All right, there's so few that actually pop up. I think maybe a couple of dozen during the sweet spot season. So, think of it this way. If you're getting a couple of them a week, all right, let's just say you get one day, all right, and on average they cost $500, and if you're going to have them in play for a week, you're talking about really about a $2,500 float. You're floating $2,500 for the week, right? If you happen to hit the sweet spot and you're getting 10 in the 2 week sweet spot time frame, then maybe you're looking at that $5,000 area. I can tell you this. You know what? I'm gonna Mike. I want to tell this story, but before I do, Jay, are there any more questions that you see that are on the board that everyone's asking?
Well, the one I think you're going to ask for them, and Mike's talked about it, is there is a publication that's done monthly, and there's an opportunity for that. But the big thing is, while you're going through class, are we going to be looking at trades or case studies? And the answer is yes.
It's a heck yes.
It's a heck yes.
Mike, part of what Mike does, and this is really a series. This isn't, this is a multi-week series that we offer once a year. It's once a year. We don't do this all the time. And so there's a limited amount of people that can come in. And the reason why is you can't teach too many people what it is that Mike and I and the folks here do, because you don't want to rock the boat and cause this particular strategy is not like going long or going short. You're going both ways, and you're doing it in a predetermined time frame ahead of an event. So we don't want to push volatility too high. So we know what that sweet spot number is, and between our folks that already get Tom's option tools and the folks that are here right now that have never looked at our tools before, and have never taken any of our premium classes, that number is about 30, and so we broke that up, and we actually have a small group that we can offer this to right here in this room. And so before I go any further too, Mike, I gotta just tell this story. So I'm at Panera Bread today. All right. You want a real life story? I'm going to give you one. So I'm at Panera Bread, and I'm with my brother-in-law. All right. So he and I met for a late lunch. And, we're both trying to, it's, New Year, we're trying to lose some weight, get in shape, and we're doing pretty good. We're not doing as good as we could be doing, but we're doing pretty good. And so we go over there for some salads. And so I said, this is going to be a working lunch. And he says, yeah. I said, yep. I said, we got earnings trades to do. We're going to trade Mike Wade style. This guy, now my brother-in-law has no clue what I'm talking about, but he's all over it. So we go in, I got my cell phone, he has his, and we just, and guys, I'm going to say this, but I'm not endorsing this company by any means. Okay. So hear my lips. I'm not endorsing this broker, but recently opened up a Robinhood account because my son told me how easy it was. And so I opened it up, and while it has some good points and bads, the good points, it's pretty cool on the phone. I mean, it's probably the slickest app on the phone I've ever seen for a broker. The bad point is it's hard to trade when I'm used to trading platform style on a computer. It's just, it took us a few minutes to figure it out. But Mike, I want to let you know, I placed 5. Some of them were maybe a day or 2 late. I think one was a day early, but I placed 5 trades today on upcoming earnings reports that are actually happening next week. Within a week from now. And so I showed him, we fumbled our way through Robinhood, but we got filled on all of our trades. Had to do a cancel replace on one of them, but we're in. And I can tell you this, the straddles on these stocks, 2 of them were close to $600. The rest of them, $400 or less. Yeah. So it averaged out well below $500 for us today. So not only grabbing a light snack, but we took a light snack in using this account. I'm just kind of trading it, trying to check it out and see how it is. And my brother-in-law, he had an account. He was transferring money into it almost instantaneous. I told him just do 1 lots to start with. So he flipped some money. I said, you could get money in there instantaneously? He goes, yeah. And he goes, okay, it's ready. I was shocked. I didn't think he could do that, but he'd already had the account open. It wasn't like he opened the account, transferred the money, and started trading within 5 minutes, but he wanted to throw some extra money in there. Anyway, I brought that up because once I stood there and I told him, and he's going to be taking your class because he needs he's the kind of guy that likes to know these things. He doesn't like just to do it. He doesn't want to be spoon-fed. He wants to know how to do it. Just in case. He'd rather know it than just be spoon-fed. So, the big question, how to become a straddle master. So once a year we do this, that we offer this opportunity up to our group. For 2019, the Straddle Mastery series begins next week. And so we're going to talk about things like the curriculum here. And I'm just going to go quickly through here. We talk about the straddle and strangle spreads. We talk about how we profit from the Greeks, IV rush, something called the red wave. You'll learn about what the red wave is when you're in class. Back testing, identifying best rush candidates. We talk about breakout candidates. We talk about how to avoid the crush. We talk about delta neutral adjustments, so much more. This is the overall fundamental curriculum. Now, a lot of people say, why don't you just give me the button? All right. I'm going to throw something at you, Mike. You ever seen the those Ferraris, the Enzo Ferrari, the inside of it? You ever seen a steering wheel on an Enzo? It's got so many buttons on it. I sat in one of these things and I'm like, wow, where do you begin? You got to get a course on how the buttons work and how to use them. Otherwise, you're going to crash. And the same thing happens with why don't you create a button? We have created a button, but before you get the button and while you're in class, you're getting the fundamentals behind the button so you know what these things do. So Straddle Mastery is 5 weeks of 90-minute to 120-minute live webinars with Mike. All right. So you're getting all of Mike's knowledge within a 5-week time frame. There is 12 months of recorded sessions. So you get the recorded sessions, you get to go back and see them over and over again as much as you can over 12 months. There are live case studies throughout the course. We picked this time frame specifically because we're in the sweet spot of earnings. All right, so you're going to see a lot of case studies. There's live technical support throughout the course. You're going to have access to Mike through the members-only discussion boards where you can talk to Mike in between weeks, and there's much, much more. Now, the button we're talking about is something called the Straddle Trapper button. The Straddle Trapper button is a series of buttons, including Surf the Red Wave. We also have one called the Black Wave. These are for IV rush stocks. We also have something called Optimal Straddle. That goes in and it looks at specific opportunities and pinpoints them to the best entry and exit dates. And it even shows you when that earnings announcement is going to come out, whether it's before market open or after market close, and give you the entry and the exit dates based on our scans. We also have a breakout straddle, which talks about finding straddles that have the best breakouts that still survive that IV crush. So that's the button. Now, this is included, and the button is forever. All right, it's part of it's part of our software. As long as you maintain a subscription to the software that we have, then you get the button included for free. Now, I've got a triple bonus for Optionetic students. All right, because we're going to fill this class up. In fact, we're going to sell out the few seats we have left. And so to do that, part of this bonus is what we're going to offer to you. So bonus number one, we're going to do a bonus session, and it might not be right after the 5 weeks. It may be a few weeks or a month or so later, because Mike's adding a sixth week to the class, and that's where he's going to focus on the gamma scalp. All right, there'll be a gamma trapper button that's going to be included. You will know how to use it. You'll understand the foundations to the gamma scalp, and you'll understand how to use that as well. All right, bonus two. Well, you need a subscription to Tom's option tools in order to use the button. So what we're going to do is we're going to give you a complimentary subscription during the course. That is a $600 value. Plus, you'll get up to 70% off the regular subscription price afterwards if you want it. And the subscription prices with that breakout are very, very cheap. And you know, you don't have to do the whole thing. We have a small lighter version that will include the button as well, or any buttons that we have, because we do mastery classes throughout the year. But Straddle Mastery is only offered, like all of our classes, once per year. So that includes that subscription. Number three, money back guarantee. So join us for week one. That's going to be Wednesday, January 30th. All right. Yes, it's only 6 days away. Check us out. Mike's going to go through the very beginnings of dissecting the straddle and understanding the crush and going through case studies. If you just think it's not for you afterwards, let us know before week two starts. So you have a week to check it out. All right. If you just think after week one and we're going into week two, before week two starts, you think it's not for you, let us know, get a full refund. All right. These are some comments from the graduates that have taken Mike's class. This is my Beautyrest strategy. I can sleep well no matter what the market's doing. Another one wrote, another advantage of strategy is that it does not require one to be in front of the computer daily, and you can set automatic exits based on your profit targets. Absolutely. Here's a funny one. True. Can we get the SEC to require earnings every 2 months? More excellent opportunities. Straddles are traditionally thought as expensive since one is purchased and calls puts. These strategies can be traded on an account sizes less than the 20,000 hypothetical accounts, even less than 10K, because the scanner only selects the best possible candidates based on history. Great scanner. And remember, the whole scanner is built on Mike's brain. So it's, I always tell people, learn addition and subtraction before you use a calculator, because then using the calculator is so much easier. Same thing. Learn the fundamentals of this strategy before you use the button, and then the button just becomes that much more efficient. Final comment that I have here, and there are tons of comments. I just grabbed a few to show you. If I have a system over the long run that could win 2 out of every 3 trades and have my winners outpace my losers by 3 to 1, there's no other strategy that I would rather be doing. So our package price for this is normally over $3,000. We have an Optionetic special for you, all right? The 15 traders only. That's what we have room for, all right? 15 traders only, $19.95. And where do you go to get this? I've already put the link out there for you. I put it in the chat box, and I also put it, I did one of the questions. I flipped the question back to everybody, giving you www.tomgentile.com/19straddles. All right, if you click on that 19 straddles, you're going to come to this webpage. This is not published anywhere on my site. In fact, you go to tomgentile.com, you'll see everything but this. This is an unpublished page. All right. Once it's sold out, you're going to see sold out in front of this page, and you're not going to be able to take advantage of this again. But once you get here, you can see everything that I just talked about. You'll see the 15 slots available. Come down, and if you're interested, click on the orange button that says only 15 spots available. You'll come to a terms of service page. Read that. If you agree, click I agree. Once you click the I agree page, it's going to take you to our PayPal page. Just simply log in if you have PayPal, or if you don't, pay with debit or credit card is the gray box just below. If you click on pay with a debit or credit card, if you do not have a PayPal account and you never want one, that's fine too. There's a guest checkout. You can see the special price already put in. You just fill the information out, pay now. Once you do, you will shortly afterwards get a confirmation from Mike and I saying that you are in the class, and that confirmation will come with details on how to sign up for Wednesday's first of 6 classes, or 6 of the webinar series, and then information on the button that's coming out, our support information, and everything else that you need to make the most out of this series. Mike J., are there any more questions or comments?
Nope, you've got them. I mean, the link to use for a debit or credit card versus a PayPal account, that was a big one coming in. So you got it.
Awesome.
Yeah, I'd like to close with a quick comment. You know, Einstein was quoted once as saying, or many times as saying, a life lived in service of others is a life worth living. You might be wondering why I do this, and the reason that I do this is, and we've had many testimonials to this effect, but people are actually doing well with this system. A lot of traders that have been on the sidelines and just not making it work have taken this system, and it's actually having a really positive impact on their trading lives, and then ultimately their lives in general. And that's what this class for me is about. It's really about contribution. It's very kind. It's loving even. And I'm just hopeful that you'll join us, and I can tell you for sure that you'll enjoy the experience.
Awesome. Thank you, Mike. Thank you, Jay. And thanks to all of you who joined us tonight. I will have a recording out to you as soon as possible with links to the recording as well as to this offer here. We're down to 10 spots already, so it's going to go fast. If you're at all interested in this, take advantage of it. Take advantage of the guarantee. And we will hopefully see you on the 30th. If not, I've got more Optionetics seminars that will be coming your way later in the year. Thanks, everyone. Have a great evening. Bye now.